Gold or silver? It's this age-old question for anyone thinking about finance. Which one, fits into your picture? We've got some really interesting sources you sent over looking right at this, and that's exactly what we're going to unpack in this deep dive.
Exactly. We're really going to explore the core differences between gold and silver as well as investments. We're drawing on an article by Doug Young. He's a financial investing expert, particularly in precious metals, with over 20 years in the field.
Right. And our mission today is pretty clear. Pull out the key info so you can get a handle on the pros and cons of each metal. We'll hit on things like, volatility cost, industrial uses, storage, that practical stuff, and long-term stability, all without making it too overwhelming.
Yeah, trying to make it clear and accessible. The sources touch on all those points.
Okay, so to kick things off, what's the absolute core difference between gold and silver we should keep in mind?
Well, fundamentally, gold is often seen as sort of financial insurance. It's that classic hedge against inflation, against currency losing value. It's generally known for holding up long term and being, well, less jumpy in price, lower volatility.
Okay, the stable one.
Relatively speaking, yes. Silver, on the other hand, it's more affordable, point one. And point two, it has much higher industrial demand. That industrial side means its price can swing quite a bit more often.
Gotcha. But both are seen as safe places to park money when things get rough economically. And they help diversify a portfolio.
Definitely. Both tick those boxes. They're often considered safe havens during uncertainty. And yeah, they add diversification because they tend to move differently than stocks or bonds.
Plus, this is just something about holding a physical asset, right? Feels secure.
It really does. That tangible quality provides a psychological comfort for many investors, no doubt. The article you sent actually has a helpful table comparing some key characteristics. Maybe we can walk through that.
Yeah, good idea. Let's do it. First up is volatility. Table says gold. Lower volatility. Silver. More volatile. What does that actually mean for someone listening, thinking about risk?
Okay, think of it like this. Gold's lower volatility suggests its price moves, generally, more smoothly, fewer sudden, huge jumps up or down. This tends to appeal to investors who maybe don't like big risks, who prioritize protecting their capital.
Right, playing it safer.
Exactly. Silver's higher volatility means its price can shoot up or drop down much more sharply and quickly. So that could mean bigger potential gains for someone willing to take on more risk.
But also bigger potential losses.
Precisely. It cuts both ways. Higher risk, potentially higher reward, but also higher chance of, well, losing significantly.
Okay, clear difference there.
Next.
Blaga, affordability. Gold costs more, silver costs less. Seems obvious, but what are the implications?
Well, the lower price point for silver just makes it more accessible, really. Someone starting out or with a smaller budget can buy a meaningful amount of physical silver where the equivalent value in gold might be, tiny.
So you can get more ounces for your buck with silver.
Definitely. But, as we'll probably get into, buying more ounces has implications for things like storage.
Okay. We'll circle back to that. Let's talk demand. Gold.
Yeah.
Lower industrial demand.
Yeah.
Silver. Higher industrial demand. How does that difference affect them as investments?
This is a really key point. Gold's demand mostly comes from two places: jewelry and investment buying. So its price is often driven by things like market sentiment, economic fear, interest rates, its role as money or a store of value.
So more tied to investor psychology and the big economic picture.
Largely, yes. Silver, though, it's a workhorse. It's used in so much: industry electronics, solar panels, medical tech, cars, water purification, you name it. So its demand is really linked to economic growth. When factories are busy, when tech is booming, demand for silver tends to go up.
Interesting. So a strong economy could actually push silver prices up because industry needs it.
That's often the case, yes. It adds another dimension to its price movements, one that gold doesn't have to nearly the same extent.
Okay. Now, storage. You hinted at this. Gold's easier to store, silver needs more space. Makes sense given the price difference, right?
Exactly. Gold is incredibly dense in value. You can hold a lot of wealth in a very small amount of gold. A few gold coins or a small bar can be worth quite a bit, easy to tuck away in a safe or deposit box.
But silver.
Silver, for the same investment value, you're talking about a much larger physical volume, maybe several bulky bars or bags of coins. It takes up significantly more space, so you need to think more carefully about where and how you'll store it securely and maybe the costs involved.
Practical stuff to consider. Okay, last point from this initial comparison. Long-term stability. The article frames gold as having higher long-term stability, silver lower. Why is that?
Historically, gold has just proven better at holding its value over really long stretches, especially through big economic shocks or inflationary periods. It's been seen as money, as a store of value, for centuries.
The ultimate rainy day asset.
You could say that, yeah. Silver also has value, of course, and can act as a safe haven, too. But because its price is also tied to those industrial cycles we mentioned, its long-term path can be a bit more up and down, less predictable maybe than gold's.
So gold stability comes partly from not being as tied to the booms and busts of industry.
That's a big part of it, yes. Its value proposition is a bit simpler, more focused on being a monetary asset and a hedge.
Okay, that gives us a really solid foundation. Let's talk history a bit more. Performance-wise, it sounds like gold has generally been the steadier ship over the long run.
That's the general narrative, yes. Looking back, gold has tended to preserve purchasing power more consistently. It often performs well, or at least holds its ground, during economic downturns, or when inflation is high, times when other assets might struggle.
The classic flight to quality asset.
Exactly. Investors often flock to it when things feel uncertain.
And silver, with its industrial side, is more reactive.
It can be, yes. Silver certainly has the potential for really strong price gains, particularly if industrial demand surges during an economic expansion. But it's also more vulnerable to slowdowns that hit manufacturing. So you might see higher highs, potentially, but also lower lows compared to gold.
We talked about volatility affecting risk. How does it impact liquidity? Like, how easily can you buy and sell this stuff?
Generally, gold's lower volatility contributes to a very deep and liquid market. You can usually buy or sell significant amounts without drastically moving the price. That's attractive for large investors or institutions focused on wealth preservation.
And silver.
Silver's market is also liquid, don't get me wrong, but its higher volatility can sometimes mean slightly wider spreads the gap between buying and selling prices. It might cost fractionally more to trade, especially very large volumes compared to gold.
Okay. Let's circle back to that industrial demand for silver. You mentioned electronics, solar. What else? Is it really that widespread?
Oh, absolutely. It's quite remarkable. Beyond electronics and solar, its conductivity is key in EVs, switches, connectors. Its antimicrobial properties are used in medical devices, wound dressings, water filters. It's a catalyst in chemical production, used in brazing alloys, bearings, photography still. The list goes on.
Wow, okay, so its fate is tied to a lot of different sectors growing or shrinking.
Very much so. Think about the green energy transition, huge demand for solar panels. Think about increasing electrification. These are big trends that potentially drive silver demand.
Contrasting that with gold, primarily jewelry and investment, how does that mix affect its price behavior?
Well, it means gold prices are often more sensitive to investor sentiment, like we said. Fear about the economy, geopolitical risk, changes in interest rate expectations, central bank buying. These are major drivers for gold. Jewelry demand is significant too, but it can be a bit more stable, sometimes influenced by cultural factors or disposable income in key markets like India and China.
So less about specific industry output, more about the global mood and monetary policy.
That's a good way to put it, yeah.
Let's make the storage thing really concrete. Say someone listening has $10,000 they want to put into metal. What's the physical reality of storing 10K of gold versus 10K of silver?
Okay, $10,000 in gold, depending on the exact price per ounce, might be, say, around 4 or 5 ounces. That could be a few standard 1-ounce coins or maybe a small bar. It's compact. You could probably hold it in one hand. Pretty easy to store securely in a decent home safe or a small bank deposit box.
And the same $10,000 in silver.
Ah, very different picture. At current ratios, $10,000 might buy you, maybe 350 ounces of silver. That could be several large 100-ounce bars or quite a few cubes of 1-ounce coins. It's significantly bulkier and heavier. You'd need a fair bit more space, maybe a larger safe or dedicated storage. It's just physically more cumbersome.
That really drives the point home.
Yeah.
Okay, the article quotes Bankrate saying, gold is more expensive but can provide a better return in the long term, while silver is more affordable but has lower returns. Is that a fair summary of the trade-off?
It's a succinct way to capture the general perception, yes. It highlights that core choice. Pay more for gold's perceived stability and long-term track record, or go for silver's lower cost and potential for price pops, accepting maybe less historical consistency in returns.
But with the usual caveat.
Always. Past performance never guarantees future results. Markets change, conditions change. It's a useful shorthand, but not investment advice cast in stone.
Right. Now, economic conditions again. both safe havens, but gold is often seen as the more reliable one in a downturn. Why that distinction?
It mainly comes back to that stability in history. Gold's role as a monetary asset, detached from industrial cycles, makes it a cleaner fear trade. When things look really bad, investors often default to gold as the ultimate store of value.
And silver's industrial ties can be a drag then.
They can be. If a severe recession hits and industrial production plummets, that reduced demand could put downward pressure on silver's price, potentially offsetting some of its safe haven gains. It doesn't always happen that way, but it's a factor that makes gold seem perhaps a pure safe haven to some.
So if your number one goal is just pure wealth preservation in a crisis, gold might have the edge historically.
That's often the argument, yes.
Okay, bringing it all together for the listener. How should they decide if gold or silver, or maybe neither, is right for them? What questions should they ask themselves?
It really boils down to personal factors. First, risk tolerance. How comfortable are you with prices potentially swinging wildly? Or do you sleep better with something steadier? That points towards silver or gold, respectively.
Stability versus potential upside.
Exactly. Second, what are your goals? Are you saving for retirement decades away? Long-term preservation? Or are you looking for maybe shorter-term growth potential? Third, budget. How much capital do you have to invest? Silver's lower price makes it accessible.
And maybe it's not an either.
Absolutely. For many people, the answer isn't gold or silver, it's gold and silver. Holding both can offer a balance: gold for stability, silver for that potential growth kicker tied to industry, diversification within precious metals, you could say.
Makes sense. Okay, let's say someone's leaning towards gold. What are the main ways to actually invest in it?
The article touches on the common routes. Physical bullion bars and coins gives you direct ownership. You hold it. But you need secure storage, maybe insurance. Reputable dealers are key.
Right. What else?
Then you have ETFs, exchange-traded funds. These trade like stocks, track the gold price. Very liquid, easy to buy and sell through a brokerage account. Downsides: you don't own the physical metal, just a share in a trust that does. And there are usually small annual fees.
Okay, convenient but indirect.
Yes. Then there are futures contracts. More complex, involves leverage. Really for experienced traders, potential for big gains, but also big losses. Not for beginners, generally.
High risk, high reward territory.
Definitely. And finally, mining stocks. Buying shares in companies that mine gold. Gives you exposure to gold prices, plus potential company growth and maybe dividends. But it adds company-specific risk management, operations, etc. So mining stocks can be even more volatile than gold itself.
So to recap gold's pros: stability, inflation hedge, liquidity; cons, higher cost, storage issues for physical, fees for ETFs.
That's a good summary, yes.
And for silver, what are the parallel options?
Very similar options, really. Physical silver, bullion bars, and coins. Again, direct ownership, but remember, the storage issue is magnified because it's bulkier. You need more space.
Bigger safe needed.
Potentially, yeah. Silver ETFs exist too, just like gold ETFs. They track the silver price, trade easily, have similar pros like liquidity and cons like fees, and no physical ownership.
Futures and miners too.
Yep. Silver futures contracts, same deal as gold, high risk for experienced traders, and silver mining stock shares in companies digging up silver. Again, exposure to the metal price plus company risk, potential dividends, but likely higher volatility than silver itself.
So for silver, the pros are affordability, that industrial demand upside, potential for big price moves; cons, higher volatility, the storage space challenge, maybe less proven long-term stability compared to gold.
You've got it. Those are the key trade-offs.
Yeah. This has been super helpful. Now, the article finished with a little peek into the future. Mentioned analysts being bullish on gold for 2025 and predicting maybe a 20% surge for silver in 2025. It also hinted at more detail being available elsewhere. What should we make of that kind of forecast?
Well, it shows there's current market optimism, at least among some analysts. The positive view on gold might stem from ongoing worries about inflation or maybe geopolitical instability. The big prediction for silver could reflect high hopes for industrial growth, green tech, electronics booming.
That's just a prediction.
Exactly.
Yeah.
Analyst forecasts are interesting, they provide context, but they are absolutely not guarantees. Markets have a way of surprising everyone. It's something to be aware of, perhaps, but shouldn't be the sole basis for an investment decision.
Understood. Okay, let's wrap this up to bring our deep dive to a close. What's the final thought?
I think the main thing is that gold and silver really offer different things. Gold, think stability, long-term hedge, the classic safe haven. Silver, think affordability, industrial demand driving potential growth, but more price swings.
Yeah, two distinct
Yeah.
personalities.
Right. And the best fit for you really hinges on your own situation, your comfort with risk, what you're investing for, how long you plan to hold it, your budget.
So a final question for everyone listening. Thinking about your own finances, your goals, does gold stability or silver's potential resonate more right now? And, maybe more importantly, why? It's worth mulling over.
Definitely.
This deep dive hopefully gave you a strong foundation. From here, you can dig deeper into the actual investment methods, physical, ETFs, whatever feels right, based on whether gold, silver, or maybe a mix, seems to fit your personal strategy.
And just remember, the investment world keeps changing. So keep learning, stay informed. That's always key.